G'day everyone, welcome to this information webinar, and we've titled it the best stocks in 2014, and I'm certainly going to do some of that, but frankly if all you got out of this webinar was a few stock tips in isolation of other things, then that information would not be worth very much to you. Yet I know, particularly looking down the list of some of the attendees, that a lot of people are just looking for stock tips. And if that's the case, then I really got to tell you that you're shortchanging yourself dramatically. So whilst I'll cover what I believe to be some of the better trends of 2014, please bear in mind that any piece of information about buying or selling a stock in isolation of a whole lot of other considerations, which I'm going to go through tonight, is not really worth very much. So there's a really strong opening message for you. Now, just before I get started, I just need to point out that I operate under the license of Avestra Capital, and that any advice in this session tonight is general advice only. So I'm going to go through some of the things that, from my getting on towards 30 years in the market, I've discovered are really the essentials of good trading and investing. It's how you make money. It's the sort of information that most people don't really want to pay too much attention to, but it's the most valuable information that I could possibly give you, far more important than a few stock tips. So please bear that in mind as we go through, and there'll be some time for questions at the end. So let's get started. And I'm going to move through this fairly quickly, but that does not downplay the importance of it. These are absolutely the critical things, the critical attitudes that you need to have if you want to have any hope of success in the market at all. So it's all about risk and reward. Most people want to look at the upside and not worry too much about the downside until it bites them on the backside, and then they don't know how to handle it. So any transaction you make in the market is not about how much money you can make, it's about how much you can make relative to how much you can risk. So the first step in good trading and investing is to protect the downside and have a methodology that leaves the upside open to run. Now, anyone that's been around the market for a little while has heard that many times before, but I wonder in the heat of battle how many times you actually think about it. The second thing is the importance of asset allocation, and I really can't emphasize this enough. It's not just about picking stocks that produces good results or outperformance. You've got to get the long-term big picture calls right. You've got to get the sector calls right. There's no point in trading or investing in a stock if the global market is not conducive, if the Australian market is not conducive, and if that sector is not necessarily going up. So you've got to get some of those long-term big picture calls right, and that's what I spend a lot of time doing, because that's really an important first step. Now that minimises unnecessary losses, which goes to the first statement, which is protect the downside. And it also helps you to improve the gains, because then you're more focused on what is actually going up at the time. And again, I get lots of questions from members and also from non-members about various stocks where clearly people are trying to pick the bottom. And it's just not the thing to do. Why not focus your attention on what is actually going up? So the importance of getting those big picture calls right cannot be overstated. Now, all the best traders that there have ever been will have this attitude. So this is the attitude of the champion traders about winning and losing. So that is that whether you're right or whether you're wrong on a particular trade is really neither here nor there. It's how much you win when you're right, and it's how much you lose when you're wrong. So that's just another way of stating what I said before. Protect the downside and let your upside run. Now, unless you've got a process for doing that, it's going to be very difficult to consistently make money in the market. Now that process can be very mechanical, or that process can be somewhat discretionary, but you need to be very, very clear about what your process is. So again, this is going way beyond just simple stock tips. The next thing is that you must remain open-minded at all times, and you've got to trade what you see and not what you think should be there. It's a natural tendency of all human beings to form an opinion about something and then look for evidence that justifies that opinion and block out any evidence that is contrary to that opinion. And if you do that, then you're pretty much dead in the market, because markets are always in a state of flux, and what may have been the prevailing trends a few months ago may not necessarily be that anymore. So trade what you see, not what you think, and be prepared to change your position without hesitation. Don't cling on to something because you got married to that particular concept. You've got to be prepared to change without hesitation. Now, one of the really key things that it's fairly simple, but again, not many people pay much attention to it, is something that's called phase analysis. And I'd just like to explain what phase analysis is for those that haven't encountered that term before. And also, in the process, just have a look at where markets are currently at the moment. So we'll start off, and we'll have a look at, as a way of explaining this, we'll have a look at the US dollar price for silver. So you can see here, here's a line chart of the price of silver going back to the middle of 2007. So you're looking at about 7 years of price history in silver, spanning from right down the bottom, about $9, and it peaked out around $49 in 2011. Now, there are 4 phases to any market. It's built around psychology, and each one of those phases has its own telltale characteristics. Phase 1 tends to be a period where people aren't too interested. The price is generally fluctuating either side of the moving average, and you can see there's a purple line here which is essentially just going up and down. That's the 150-day moving average, which is what I use. So phase 1 is when the price is fluctuating up and down around that moving average. There's not a lot of interest in the market at that point in time, and it's only really the people that are really tuned in to what's going on in the market that will start accumulating their position during that phase. Now, eventually, you can see the price starts to spend more time above the moving average. The moving average line, the purple line, starts to move up, and we start to move into phase 2, which is the buying cycle part of the overall phase analysis. So initially, you can see with silver, it's a bit of a volatile little beast. It went up at a reasonable rate. It doubled over the period of about a year or two, but then it really took off in August of 2010, and in the space of it looks like that's only about 8 or 9 months, the price just absolutely blasted from around $18 and got up to $49. So that whole period there was phase 2, and you'll notice that it's characterized by the fact that the purple line, the moving average, is ascending strongly, and the price is well above that. So that characteristic is quite different to what we saw in phase 1. Now, eventually, markets run too far, and we start to get some wild fluctuations as some of the smarter money starts getting out early when they recognize that the market's overheated. And so we move into phase 3, which is characterized by these wild swings up and down. The price now starts to cut through the moving average, as you can see here, and the moving average starts to roll over. So that's all part of phase 3. So you can see the characteristic of that market is quite different to phase 1 or phase 2. Ultimately, we move into phase 4, where the price now starts to live below the moving average. The moving average is clearly in downtrend. We get the occasional blip upwards, but that was clearly in phase 4, all through this period here. And then eventually we get back into phase one, where people who've all lost their money down through here, which is the majority of people, they just want to get out, and we get a period then where the market essentially goes sideways. So if we tighten in on this period and look at where silver is at the moment, you can say, well, on a big picture view, silver is definitely in a phase one consolidation, and that at some stage we'll move back into phase two. Now, are we starting that phase right now, or is that phase a little way off? I'm not totally sure. The ultimate confirmation would be a move above $24.50. So that would give me ultimate confirmation, but there are some promising signs here. But it doesn't mean, just because we don't have ultimate confirmation, that you can't actually start to trade this. And again, it comes back to having a process. If you just want to go in and have a punt at buying some silver, and the first time you do it, it doesn't work, then you're probably going to find you're going to lose money. So you can trade these, on all kinds of different time frames, as long as you've got a pretty clear process about what you're doing. So let's have a look at some of the other markets and get a bit of a sense of where we are now that you've got that blueprint in your mind. So let's first of all look at the most important index in the world, and that's the S&P 500. So I'm going to pan back here around about 20 years. So you're looking at about 20 years of history on the S&P 500. And you can see we formed some major highs in April 2000 before the market fell apart, and then of course another major peak at the same level in October 2007. That eventually led, of course, into the GFC. Now, since those lows in 2008, you can see the S&P index has moved from just under 700, and now it's about 1850. Now, looking at that chart, what phase is the S&P 500 index in? Clearly, the moving average is still heading up. Clearly, the index is holding above it, comes back and has a little touch of it every now and again. But despite what you might be reading from various sources, all the doom and gloom people are always constantly out on the march. There's only one conclusion you can draw, and that is at this stage the S&P 500 index is still in phase two. We are still in a bull market, and I don't care what anyone says. If they can see things other than a continuation of the bull market, then they're just playing on hope or something else. So quite clearly, we've got a strong rally. It's still in process. Let's have a look at the Australian market. Let's have a look at a couple of sectors of the Australian market. I'll look first of all at the materials index. So this is largely BHP and Rio Tinto. So again, we're looking here at about 10 years of price history. And since the big sell-off in 2008, we had a massive recovery, and then it sold down again as people became extremely fearful about China. And you'll see the marked difference to the banking sector index. So where is the material index now? We've gone through phase 2, phase 3 and 4, and we're back into phase 1, and it's certainly showing some fairly positive signs at the moment. I believe 2014 will be a great year for resource stocks, and there'll be some terrific opportunities. But resource stocks are far more volatile than banks and stocks that you may have been involved in the last 1 to 2 years. So it requires a better game plan. Let's have a look at the finance index. By comparison, you can see totally different. It's been in uptrend now for quite some time. It's been out of its phase 1 base since about June of 2012, so in excess of 18 months. So quite a big difference. Let's just have a quick look at the FTSE index. So this is the UK market. Pan back and have a big picture look. We're basically at all-time highs. So despite the fact that the UK economy is not exactly travelling all that well, it's trading at almost the all-time peaks. And again, you've got to say there is no evidence there of the FTSE index rolling over at this stage. It is cutting through the moving average a little bit more than some of the others, but it's still in uptrend until further notice. And finally, I'll just have a quick look at the Chinese index, the Shanghai Composite, and you can see that we formed an amazing high in 2007. It dropped by 75% during the GFC, and then since then it's been a long, drawn-out phase one, and really no evidence yet that it's moving back into phase two. But I can tell you that will come. As sure as night follows day, we will move back into a phase two in the Chinese market. There are people out there that are pointing to all sorts of bad news about China. Frankly, I think they're ignoring the good news. And secondly, the bad news is priced in, and you can tell that just by looking at the price chart. The moving average has stopped declining. It's going sideways. The price is starting to move backwards and forwards, above and below it. So we're in a phase one consolidation in the Shanghai market, and eventually we'll move back into an uptrend. So let me move on. There is a four-step process for profiting in the market. The first one is that you've got to determine the big picture, and that's, I guess, partially what I've just done in the last few minutes. Now, most traders can't do this, even if they've got the time to spend absorbing all the information. Most traders can't do it because they're not open-minded enough. Their mind has certain preconceptions about what should be, and often they are just taking their cues from the media, and the media will always absolutely have you thinking the wrong way at exactly the wrong time. So important to get the big picture correct. That allows you to make your asset allocations correctly, get your sector calls right. The second thing is to find strong fundamental performance. Now, we can trade just on price pattern alone, but if you want to improve your chance of success, then identifying really strong fundamental performers is a really important thing to do, because it just enhances your chance of succeeding. The third step is to place a realistic valuation on them. There are plenty of great stocks in Australia that are in terrific uptrends, but some of them are so exceedingly overvalued that the risk-reward is just not appealing at all. And yes, you might make a bit more upside, but your risk of downside is significant. So we want to get a sense of what's a realistic valuation before we move too much further. And then the fourth step in the process, of course, is to use some high probability chart setups. Now, tonight I can't go through this in any great detail because it's a training exercise that would span many days. So all I can do is just touch on a few fundamental principles, and I guess try to influence your thinking in how you think about the market and how you think about your trading and investing. So overall, at the index level, this could be a major topping process, maybe. Personally, I don't think so. I think we might see some new highs yet, but the S&P has had an enormous run, so I am constantly on alert for any change in that pattern in the S&P. But at the moment, I'm not seeing it. But it is something to be aware of, because this bull market has been running for a long time and it's starting to defy the historical odds. So, just be aware. I think 2014 is going to be a great year for trading and investing, but look out for the volatility. Now, at the individual stock level, the value can be substantial. In the American market in particular, some of the valuations are just at nosebleed levels. They are ridiculous, but there are also plenty of stocks that are tremendously good value relative to their their earnings growth. Now, typical of fairly advanced bull markets, and we're 4 or 5 years into this bull market, it gets more difficult because of the volatility, but at the same time, it gets potentially more profitable. And I guess that's one of the features we're going to see of this year. We're going to see higher volatility, but we're also going to see a lot more opportunities. Quantitative easing, we've had 3 bursts of it now. The Fed is just starting to reverse their way out of the last lot, QE3. It's completely distorted the market. So a lot of the old relationships that, you know, people used to hang their hat on, if the currency did this or if the bond market did that, then we could expect X in the stock market. A lot of those old relationships now are not worth anything. So I'd really encourage you, if you've got a bit more experience in the market and you're used to doing things a certain way, you really need to take a more open-minded view of what's going on and what you're seeing. So my key messages, I'll start to move on to some more specifics on some of the stocks, but some of my key messages for tonight are that there are new trends starting, and that's just part of the normal rotation in money flows. We saw in 2012, in the middle of 2012, we saw the ECB, the European Central Bank, basically say we will print as much money as we need to for as long as we need to until we fix this problem. And from then on, markets strongly pursued high-yielding stocks. That went on for about a year, a little bit more than a year, and in the latter half of last year, investors looking down the track now, seeing that interest rates are going to stay at almost zero overseas for an extended period of time, started to think we just have to start taking some more risk. So money started coming out of the bond market, going into equities. Money in equities is now starting to move out of high-yielding stocks, which might be low-growth stocks, and moving into the more growth stocks, which might be resources, gold stocks, and more cyclical industrial stocks. So these trends, they're nothing new. They always happen, and that's why they're reasonably predictable, because economies and companies all go through cycles. The second key message is that the media is always going to be quite late in picking these changes and telling you about it. So if you watch the news, the news programs like CNBC on TV or the local business channel, or particularly if you're reading the media, don't expect to be right up front and on cue with what's actually unfolding, because these guys are always late to the party. The third key message is that there is a firm process to make profits and to be able to hold on to them. If you are not crystal clear about your purpose for what you're trying to do in the market and the methodology that you're using to make money, then you've got very little hope of consistently making money. Now, a lot of people, I think, look at me when I say that, and I'm not sure whether they believe me or not, but if you don't believe me, you'll find from bitter experience that that is the case. So you absolutely need clarity about purpose and process if you want to hope to do any good in the market. The next thing is, and I've referred to this a couple of times, you've just got to be able to recognise the signals and accept them for what they are. And I've rubbed shoulders with, literally thousands of different traders over the last decade or so, and lots of people can read the signals. You just need a pair of eyes and someone to show you the way. So reading the signals is pretty easy. Where most people struggle is accepting those signals for what they are, and that's because of the bias, the preconditioning in their mind. These things are really easy to overcome, but most people aren't prepared to do the bit of work on themselves or put themselves in a position where they can actually overcome them. Let's have a look at a couple of examples. So these are just a few of the key chart signals, but again, I stress that any signal or any stock recommendation taken in isolation is just not the way to go. You've got to be able to look at the bigger picture first. So let's have a look at this Australian stock called Collection House. They're in the credit business. We'll pan back here and take a big picture look at these guys. You can see there was an enormous phase one that lasted quite a few years, and the stock started moving around about August of 2012. So about 18 months ago, the price was trading around about the dollar mark. Since then, it's moved into quite a strong bull market. We've had a couple of consolidation periods, but really it's still in uptrend. And we've just come out of another period of consolidation and really look like moving higher. Now, there's a particularly clear signal that I use, which is highlighted, had it highlighted here before. I'll just put this little box back so you can highlight the particular area. So this is a really clear example of a clear reversal in sentiment. You can see that the stock had been trading downwards from July 16 of 2013. It had been basically trading in a bit of a slight downward direction through till November. Now, we had 2 or 3 days in a row where the stock sold off quite suddenly, and was closing on its lows almost every day. So the conclusion you make is that the sentiment is quite negative. Now, in the space of 24 hours, this blue candle here on the 13th of November indicates that the price had suddenly turned around, or sorry, the sentiment had suddenly turned around from being somewhat negative, having moved to a negative extreme, had it now turned around and become very positive. And we had 1 day of pause, but from then on it was basically off. So from $1.58, this trade has run up pretty close to $2. It's certainly not a point to be getting into at this stage, but fundamentally this is a stock that's in good shape. I believe they present really good value. They are in a sector that's got some good earnings momentum. So I think as a stock to potentially trade higher through 2014, it certainly does tick some boxes. But I wouldn't be necessarily jumping into that stock at this point in time. Let's have a look at another stock that's getting a bit of airplay at the moment in the media. It's called G8 Education. They're doing what ABC Learning did before the GFC, and they're accumulating childcare centres, but they're doing it in a much more business-orientated, sensible way, and so their business model is much more sustainable. And you can see that just by looking at the price chart. Now, there was a pretty clear entry signal that we use again around about here, late December of last year, at around $2.90, and from then on the price has moved up quite sharply, and as you can see is still in strong uptrend. We got a really nice breakout here about 2 weeks ago, and so that's turned into a really nice trade, and clearly there's a very strong uptrend that's in progress there. So again, it's a stock that there's a great trend, and what you'd be looking for here would be to buy a pullback in the stock at some stage over the next month or so. Now, this was another signal that came up just recently, a little bit similar to the first one that I showed you. This is a company called Slater & Gordon, which is a law firm specialising in accident claims and also in class action lawsuits as well. They're expanding internationally. Fundamentally, the business is pretty good. It's not normally the sort of business I would look at, but you can see there's a very, very clear and very strong uptrend in progress here. There was actually quite a good entry signal just over the last couple of days. You can see here we had quite a negative sentiment on Tuesday the 11th, and then we got a huge abrupt turnaround in sentiment the following day on the 12th, and that was accompanied by a pretty substantial volume spike, as you can see down here. So that was a signal that we find has quite high probability attached to it, and the price has moved quite quickly from around the $4.50 level and actually got extremely close to $5 today. Now, again, I wouldn't necessarily take this trade tomorrow, but there is a strong long-term uptrend there, and this is a stock that I think will continue to provide entry opportunities throughout 2014. So just a couple of examples of some of the stocks that and some of the patterns that will do well in 2014. But I will come back to that shortly. But first of all, I just want to have a look what actually makes a great potential trade or investment. So these are just some of the key things that I look at when I'm going through that evaluation process. First thing is it needs to have strong future growth in earnings. So the earnings need to be, pretty robust now, but we need to be able to look down the pipeline a couple of years and envisage that the business conditions are going to allow that growth in earnings to continue. And again, to make that judgment, you really need to be on top of the market. You need to spend a lot of time researching and really understanding the drivers of the different sectors. And the reality is that most people don't remotely have the time to do that properly. The second thing is we need to find stocks that are undervalued relative to those earnings. So if a company is growing its earnings at, let's say, 20% a year or 25% a year, and you can buy it for a price earnings multiple of, let's say, 10 to 12, then you're getting a heck of a good bargain. In the short term, we can't be sure what the share price will do, but we know that over the longer term that the share price is, as long as those earnings continue into the future, that shareholders will be rewarded with a nice capital gain for there to be some sort of catch-up. For those that are relatively new to the market, a company can be going really, really well and the market just doesn't pick up on it for sometimes 3 months, 6 months, sometimes even longer. So as long as you understand what's coming in the pipeline for a stock and you understand the value that you're paying, then as long as you get in at a good technical level, then it's really just a matter of time before you make money. The next thing is that there needs to be some sort of trigger to start a new trend or a continuation of an existing trend. The fact that a company's in great shape and is cheap doesn't mean that the share price is going to move. It might sit there and look at you for another 6 months. So if you want to make the most productive use of your money, you don't want to be caught sitting on something that that is not moving. So there needs to be some sort of trigger. And the entry conditions, what we're looking for is where the entry conditions, where the reward versus the risk can be clearly framed and is attractive. Let's go back to the last stock we looked at, Slater and Gordon. So having had a reversal here, in an obvious reversal in sentiment, in a strong ongoing uptrend, then if we're looking at entering, let's say, here the next day, then we can set quite a tight initial stop loss exit, give ourselves a little bit of room to move just in case there's a bit of a spike. But let's say we set an exit down here somewhere around $3.90. So in this particular case, we're entering it around the $4.50 mark. We're saying that if the trade got down to $3.90, that there is something untoward because it shouldn't be down there given the fundamentals, given the valuation, and given the trend. We should not see the price down at this level. So in this case, we're risking 60 cents, and we need to look down the pipeline to see whether there's the potential for us to make more than 60 cents worth of gain out of this trade by various mechanisms. So in this particular case, we can very clearly frame an entry, an exit, and this is a business proposition. This is not just some trade that we're going to take on a whim. This is a business proposition. We get in here. If it fails, we get out here. That's X amount of money. We're comfortable losing that. Yep, move on. And that's the way you need to approach your trading, not just, well, I'll have a crack at this, and if it doesn't work, well, plan B, and you don't really know what plan B is. So you've got to be really clear about how you set these trades up. Now, let's have a look at some existing strong trends and some new trends that I believe will be some of the real winners in 2014. So these are at the sector level. Precious metals. Gold and silver we're not there yet. We don't have ultimate confirmation, but gee, the signs are looking good, and the fundamentals are fantastic. I mean, we've been in a 2-year horrendous bear market for the share price of gold stocks, but the fundamentals around gold and silver, the actual metals themselves between supply and demand, have never changed. All that happened was the price went down. So, you've got to distinguish between the reality of what's actually happening in terms of supply and demand and the price fluctuations, which can be quite random at times. So the signs are looking really good for precious metals, and we'll have a look at some of these possibilities in just a minute. US technology stocks are also in strong uptrend, and the next couple of years I can see tremendous gains in certain sectors. Now, some parts of the US technology market are way overblown, and you wouldn't want to touch them with a 40-foot pole. But by the same token, there are some stunning bargains still. There are stocks that are growing their earnings at 20, 25%, 30% per annum, and are trading on 10 to 15 times earnings. That's a bargain, particularly in high-growth companies. And so, there's some tremendously exciting opportunities there. For those of you that that may be looking at diversifying into overseas markets, and from what I read, I'm seeing an increasing willingness to do that. People are becoming more open-minded about moving out of Australia. The Australian market does have limitations. There's no question about that, and that overseas there are opportunities that'll make your eyes water. The next existing revolution that's on the big picture level, really just getting underway, is the US energy revolution, the shale and gas revolution. There's many ways to play that. My focus is playing that via the guys that are building the infrastructure rather than necessarily buying the companies that are producing oil and gas. There's a few good ones there, but the guys that are building the infrastructure are a much lower risk and better reward proposition, I believe. Next is resources in general. Copper has remained strong during the last 2 or 3 years. Any of the decent copper producers are quite profitable despite the fact that their share prices have been lagging. Resources in general have just been out of favour. We've just seen great results from BHP and Rio, so iron ore profitability is still really good for the companies that have got their costs under control. And there's even a possibility we might see some bounce back in nickel and a few of the other base metals as well. So resources in general, I think, are looking extremely attractive compared to their potential growth rates. Online services, so I'm talking the online travel companies, the online service companies are also a theme which is really strong. Now, some of them are very expensive, but some of them have been sold down because of certain perceptions. Those perceptions, such as Webjet, such as carsales.com, the perception has been that the Australian market is slowing and is going to limit them. What investors are missing is the fact that these guys are expanding overseas in a very promising way, and there's virtually nothing built into the share price for the overseas expansion. So I think the market is missing some opportunities there in online services. Healthcare is just it's probably the strongest sector without any question at all. The most difficult thing with healthcare is getting something that's value. They always seem to be trading on a very high valuation, so sometimes difficult to get value there. And the final one is ICT, Internet and Communications Technology, which takes in a basket. We've got a few players here in Australia, some good ones, IONET, MTU, M2 Telecommunications, Amcom. So we've got a few good ones, but you can probably count them on one hand. In America, the opportunities in this space are substantially more. Well, let's have a look at a few examples of some of these. First of all, just take a look at precious metals globally, I'll look at the GDX index, which is the gold miners index for the major 16 stocks I think it covers in America. So these are the 16 biggest stocks. So again, from a big picture view, you can see gold stocks had been absolutely smashed. The value of the GDX index had fallen from 66 to 20 during that bull market, with most of the damage done during 2013. It really was pretty hard work. You can see the 150-day moving average has been falling. It's finally flattening out, and we've now got the GDX index has moved back above that. So that's the first sign for me that something has changed. The character of the market has changed. We've finally stopped the bleeding, and it's starting to move back into uptrend. Now we've had a little move above this high level here, or it's probably pretty much sitting on it now. The ultimate confirmation I'm looking for is a move back above this level here. But you can be trading gold stocks and making profit, and we are in some local Australian stocks. So you don't need to wait for that ultimate confirmation. Let's have a look at carsales.com. If we pan back, you can see there's a big picture uptrend in place. However, are we into phase 3 on price? Yes, you'd have to say that there's been a significant change in the character. So you've got to be cautious. However, I believe the market has just got this one wrong, and you can see the price was sold down sharply, and then when the company came out with their half-yearly report, it was much, much better than what the market was expecting, and so the price has just rocketed right back up again. So I think in time we'll see that this was just a bit of an anomaly. The market got it wrong, and this will go back into perhaps some sort of consolidation phase. Let's look at Webjet. Again, they were treated even more poorly. You can see that the market really sold off heavily on Webjet. Moving average still heading down. We haven't got back above it yet. However, you can see this really big jump in price, which occurred only a couple of weeks ago. Jumped in price from $2.50 to $3.10. And that, again, was on the half-yearly result, which was much, much better than the market expected. So an opportunity there. I believe that the fair valuation on Webjet is considerably higher than where this market opportunity is. So depending on your trading style, whether it's aggressive or conservative, I think there's some good opportunities in Webjet. This is an ETF in America which basically encompasses all the major stocks. So this will include Apple, Microsoft, Google, Facebook, Oracle, all those companies. And you can see that it really took off around about September last year, and it's moved from $86 to about $116. So clearly big tech in America is in a very strong uptrend. Now there's a couple of those really big tech guys like Google and Facebook that are stupidly expensive, but other stocks like Apple, Oracle, Microsoft still represent extremely good value. Let's have a look at FMG. I believe this will be one of the big winners of 2014. If you're looking for a long-term trade to get your teeth into, I believe on fundamentals this stock should be at least 50-60% higher than it currently is. There's a couple of ways that you can trade this. It's not really appropriate for me to stipulate because it really does depend on your trading style and tolerance to risk. But for those that are interested in a stock that really should have terrific upside, Fortescue is a good one to keep in mind for this year. This is MTU in the telecommunications space here in Australia. It's been in a great uptrend, moved from $3 to $7. We've had the obligatory consolidation period now, which always comes after a strong rise, and their half-yearly results just out yesterday were right on track, and I believe it's just a short matter of time before this stock moves back into uptrend. And the other one, of course, is Real Estate Group, or REA Group, which has been the best of the online performers. These guys are significantly overvalued in my view. It's been an enormously strong uptrend. I wouldn't buy them here, but I'd certainly be looking for opportunities to buy them on any sort of significant pullback. Okay, let's move on. So there's some of the themes and a few stocks to look out for 2014. But again, please let me reiterate, taking those stock recommendations in isolation is just not the way you need to go about this. If you want to make money out of it, it needs to be part of a big picture. It needs to be part of a coordinated strategy. What to look for? Strong fundamentals. Looking for good return on equity, good earnings growth. I'll just whiz through this very quickly because I know most people aren't interested in doing their own fundamental analysis, but a few are. So return on equity, growth in earnings, growth in dividends, these are the key things to be looking at. Manageable debt. When it comes to a valuation, ideally we want a cheap valuation relative to the earnings growth rate. So that's really the key. If a stock is growing at 25 or 30% earnings growth rate, and I have to pay 16 to 18 times to buy it, then that's still a bargain. But if a stock is only growing its earnings at 10% and the market's asking me to pay 20 times earnings, then I'm not interested at all. So sometimes it's worth paying a higher PE if the outlook is good enough. But again, you really need to understand the market, you need to understand the sector, and you need to understand what the stock is doing and be able to look a couple of years down the pipeline. Online services and healthcare, they're trading at expensive multiples, but their growth rates in earnings are extremely strong. Next thing is we want to look for a high probability entry. There's basically only two things that we're looking for. We're either looking to buy breakouts from a phase one or from the restart of a trend that's already in progress, or we want to buy a reversal. That's it. Price goes down, we're looking for it to start to reverse back up again. There isn't anything magical about technical analysis. It's really about just understanding a few of the simple things that work, but most importantly being able to retain an open mind. So it's really about being able to trade what you see and not what you think should be there. I think 2014, it's probably going to be better this year to trade reversal patterns than breakouts. Given the volatility that I expect will be in vogue in 2014, I think there could be more failed breakouts. So in other words, the stock makes a bit of a breakout and then immediately turns around and fails on it. I think trading reversal patterns is going to be a more productive way to go this year. That's certainly what I'm focused on for our members. The exception to that, of course, is a strong phase one breakout, and we're certainly seeing that in silver at the moment. If we just zero in on silver, we really tighten this up and look at the last little bit, you can see that we had a really clear phase one here where the price was just basically tracking along between $19 and about $20.30, and then it absolutely blasted out of there. So that's a really strong phase one breakout on silver. We don't have ultimate confirmation yet, but it's certainly a promising start. I think in 2014, it's really important to focus on stocks that are already trending. If you try and pick stocks that you think should start to go into an uptrend, so you try to pick the bottom, I just don't think it's going to work too well in 2014 because we're really well advanced into the bull market. Stocks that have really got some substance to them, they should already be trending. Now, reversion to the mean, and that's really buying reversals. So a lot of the time you noticed that I was tending to buy stocks that reversed when they pull back to the 150-day moving average. I mean, I think that's a theme that's going to work really well in 2014. And just a word of caution for inexperienced traders, there's a natural inclination to try and pick the bottoms, stocks that used to be highly priced and now lowly priced. There's a natural tendency to want to try and pick the bottom, thinking that, you know, they're a big stock, they're going to turn around and go back up again. It really is a fool's game to try and do that. Don't do it. You're going to end up doing your shirt if you do that faster than any other way that I know of. So forget about trying to be a hero and pick the bottom and try to get an absolute bargain. You know, focus on what is. There's plenty of good stocks out there that are trending. So what's in it for you if you go through this process of of getting clear about what you want to do, about getting clear about the process, and putting yourself in a position where you can consistently make open-minded decisions? Well, it ensures that you're aligned with the big picture of the market, and that's the most important thing that you can do. It ensures that you only consider the best and the most proven financial performers, because we are looking at fundamentals. We're not just assuming that because a company used to be good that it's still going to be good. It saves you money by avoiding the rubbish or the stocks that are overhyped, and there's plenty of them out there always. It provides a yardstick so that you don't pay too much, and thereby you limit your risk while you're targeting well above average returns. And that's what it's about. It's about risk and reward. Limit your risk and put yourself in a position to make above average returns. There is no rocket science about the stock market. There's a lot of hard work, and there's a requirement to be open-minded, and that's it. There's no secrets, and there's no real mystery around the stock market. It's just like running any other business. It also gives you a higher degree of certainty, and I'm in the fortunate position where I get to talk to hundreds and hundreds of investors and traders, and the common theme that always comes through is that most people are just uncertain about what they're doing. So this four-step process really does give you certainty about, or a higher degree of certainty about what you're doing, and therefore some peace of mind that your wealth building, whether it's shorter-term trading for cash flow or whether it's longer-term investing for the future, that it's under control. That you're going to have up periods and down periods, but over the long term you're going to make progress. So let's have a look at what else is essential. And I don't have much time to spend on this, but again, this is critical. It's about trading psychology. Most people don't want to know about it, but it's the most valuable thing that I could give you. So selection and evaluation are critical, but mastering your psychology is an absolute must. You're just not going to get anywhere unless you pay some attention to this. Now, what do I mean by mastering psychology? It's about learning how and why the market does what it does. And the only way that you can do that is over time, because you've just got to go through the market cycles. You've got to go through bull markets, you've got to go through bear markets, you've got to go through sideways markets, you've got to go through making mistakes yourself. You just have to experience the different facets of the market to understand why it does what it does. And there's just no way to shortcut that. That requires, almost by definition, being guided for a period of time to build confidence. Now, when I started nearly 30 years ago, I spent 10 years not really having much of an idea what I was doing. I tried a bit of this and a bit of that, and all I managed to do was waste time and waste a lot of money. You've got an opportunity to do that quite differently. I didn't have the information at my fingertips then that I do now. I didn't have the knowledge or the experience. You've got an opportunity to, be guided through this process and build your confidence in the process if you want to. And without you being able to obtain a calm, well-founded confidence, you really have little hope of succeeding. Now, I'm just so 100% convinced of that statement, because without it, you will always be second-guessing yourself. People can give you tips. You can recommend stock tips from all and sundry, but you'll never be completely sure You'll never feel really, really calm and confident about what you're doing in the market. And that's what brings traders unstuck more than anything else. It brings them unstuck more than the information itself. So I can't stress that strongly enough. So how do we go about mastering your psychology? Well, there's a few things you can do. This is a big subject, but I'll just give you a few for instances. You need to establish a clear game plan. You need to know why you're in the market, what you're trying to achieve, and set some rules in place that are suited for you to achieve your objectives. And you need to do that before you do anything else. If you're already in the market and you don't have that in place, then you need to stop instantly and get it done. There are some practical exercises that I work through with members of our group that make a huge difference to your attitude and a huge difference to the way that you can build your confidence in the market. Become educated. Understand a bit more about the market. What drives the market. It doesn't take a lot of time, and you don't have to, you don't have to become a researcher. There are people out there that will do things for you. So become more educated so that you can make more choices, so that you can be more open-minded. And for 99% of people, get a mentor. Most people aren't equipped to do this. I wasn't equipped to do this. The only reason that I got from point A to point B over 25 years was that I was too pig-headed to give up. And mind you, I felt like giving up on many occasions, but I didn't. So, take a far easier, far more productive route and a far less costly route and get yourself a mentor. Now, I just want to touch very briefly on the membership overview, but I'm not going to go into any detail on memberships because I'm really not interested in selling you into anything tonight or at any stage. What I've said tonight about the principles of success and the methods that I use, they either resonate with you and seem logical to you, or they don't. And I really want to reserve my time for working with those people who are serious about doing this properly. I give them everything that I've got. So that's why I'm not going to give you too much detail here, but just for those that are interested, we've got a membership for traders. It's called the Insiders Club. You get information daily, and you get all the amount of support and guidance that I can possibly give you. We got a program for investors. It's called the Dynamic Investor Program. It deals more with fundamentals and has a different philosophy and a different process of entering and exiting, but it's a program that's running along very nicely. And we also have a peak membership called Platinum, which is for those that are really serious about getting stuck into this, really want to commit to doing this properly. It's a higher level program. It also includes the American market, so I'm providing a lot of information, a lot of recommendations, and a lot of guidance on the American market. And that was why I did digress a little into the American market tonight for those that are interested. And I really would encourage you to think about diversifying outside of Australia. The Australian market is fine, but the reality is that it has these periods where everything just goes sideways. So there's really a few defined periods in the year in the Australian market when you can make money. Well, they only last for a couple of months each. Whereas in America, you can always make money all the time. There's lots of stocks, and there's lots of trends and technologies and things that we just don't have here. So the Platinum membership includes a really high level of input and includes access to America as well. That's all I'm going to say on those programs. What I run here is not just a tipping service. If you just want stock tips, there's plenty of guys out there that'll do that, and they'll provide those stock tips a lot more cheaply than I will. What I'm about is providing high-level education and mentoring for those who are serious about doing it properly. If that's you, then I can provide you with an enormous amount of value. If you just want a tipping service, then I'm probably not your man. So if you're interested, the next step, if you're interested, send me an expression of interest by email. let's do it that way. I don't want to spend a lot of time here for those that aren't interested in doing it properly and who just wanted a few stock tips. But again, let me say what I said at the start tonight. If all you take away from this webinar is a few stock tips, then really you haven't got very much at all. The value is extremely limited. If you want to learn how to do this properly, then get in touch with me and we can talk about the possibilities. The daily recommendations in 2013 that I put out, so information goes out to members every day, and we keep a very public record of those buying and selling recommendations. We produced a 34% return in 2013, and that is a matter of public record. My own trading and investing in America, which I moved money into America in the middle of 2013 and started trading and investing, is actually doing a little bit better than that. And I've had some terrific results over there. Let me just show you a couple, just to give you a bit of a feel for it. This is a stock here. So I've had quite a few trades where I'm up, 40, 50, 60% in the space of a handful of months. So there's some really strong trends. This is a stock called NXP Semiconductors. The blue line across the middle here is where I got in at $38. You can see there's one heck of a strong uptrend in place. I got into it during a little consolidation phase, and then shortly after I got in, the price took off and is trading up around the 56 mark at the moment. So that's been a fabulous trade. This is an industrial stock in America called Trinity Industries. Again, the blue line shows where I got in just as it was starting to break out into a new uptrend, and it's moved from 47, which is my entry, and now it's sitting at 69. This is a gold royalty company, which I'm particularly keen on, called Royal Gold. I got in right down the bottom here at 46, just when it was starting to make a move, so this was a little bit more about fundamentals as well, and it's moved from 46 to 68. Now, yes, I've had a few losers, but gee, they've been pretty small. They've been more the order of 5-6%. There hasn't been that many of them, and I've got lots of other things happening in America where we've made a little progress or the stock hasn't moved just yet. But overall, I'm really enthused about the opportunities over there as well. So if you are interested, if you're serious about making money in the market on a consistent basis, there's my email address. Drop me an email, and happy to chat via phone as well. So I'll pass it over to questions now from anyone that would like to ask any. Just while I'm waiting for any questions to pop in, let's just do a bit of a recap on where the market is at the moment. We've already looked at this a little bit, but there's the American S&P index. You can see just how smooth and how strong that trend is in America. There really is no sign of weakness there yet. But as I said, it's been running for a heck of a long time. It's been running now for more than 4 years, so I am alert to the possibilities. This is the Australian ASX 200. By comparison, you can see it is absolutely chalk and cheese, whereas the American market is well beyond its previous highs. We are really nowhere near it. Our previous highs were close to 7,000 points. We're still sitting at 5,400. And you can see of late, we've really, while the American market has continued to march on, our index has just continued to basically go up and down. And if it wasn't for the top 6, which is the the 4 banks and BHP and Rio, then our index would be looking a lot worse. So the bulk of our market is really not travelling all that well. This is the XSO, which is the Small Ordinaries Index in Australia, and you can see it's even further off its peak. But having said that, we had some great results in 2013 with small caps, obviously to produce a 34% return. we obviously needed to do a few things right. So whilst the overall small cap index didn't move too far, then certainly select stock picking did work quite well. Okay, well at this stage, unless I'm missing something, there aren't any questions. So I'm not quite sure whether I've answered every potential question. Okay, all right, I've got a few questions coming through now. The first one is on a particular stock called Moco Social Media. So this is an internet stock. One of the few that we've got. America's obviously got lots and lots of these guys. Look, I really know nothing about what they do, so my comment here will be purely technical. So clearly this stock started to move into some sort of reasonable uptrend in August last year. The price had moved above the 150-day moving average, which is now, clearly into a pretty healthy rate of ascent. There was some tentative volume kicked in, but the really big volume didn't start kicking in until October, and then the price broke out around 14 or 15 cents and ran to about 34. After such a strong run, you have to expect consolidation. That's what we've had. It's pulled back to the moving average. So it's in a position where a signal could be looked upon favourably. However, if you look at the candle patterns and you look at the volume, there's nothing there yet. So you could put your money into this on the hope that it went up. So again, this is about, I don't know how this stock came onto your radar, but you just got to be mindful of the fact that whilst there might be some positives about it, you've actually got to wait until it starts to move. I would rather pay 27 and get in when it starts to move with the appropriate pattern and the appropriate volume than try and, guess the bottom at 21 or 22. So there's my view on that one. Now, I've got a question here which says, what's my exit strategy? And I'm not sure what that relates to. So, Julian, perhaps you could elaborate on what you mean by that. What's my exit strategy? If you mean in general, that's really going to take me too long. It's beyond the scope of the webinar tonight to talk about exit strategies. But yeah, there's a couple of different ways that I use. To my mind, there are two broad ways you can stage your exits. One is you either have a completely mechanical approach to it, and you do that every trade, every time. The other way, which is what I do, is I'm somewhat discretionary. I have rules and I have processes around how I do it, but I'm somewhat discretionary based on, the big picture of what's happening around the world, how much exposure do I want to have at the time, what the sector looks like, what the stock chart looks like, all those sort of things. So I'm a bit discretionary on that. Have I got any comments on NST's latest run? Yeah, my comment is fantastic. We members got into Northern Star at 90. Let's just call up the chart. So we got in here. And fundamentally, the stock is just ticking so many boxes. It's not funny. I think they've got a terrific long-term future. I think they're the outstanding Australian gold stock. But you got to remember they are a gold stock. The gold price is volatile. Stocks will be even more volatile. Just knowing that this is in good shape and is probably going higher is not enough. It doesn't mean that you're going to make money out of it. You need a game plan, a robust game plan built around how you're actually going to do that. So my answer to your question is I'm very positive, but you want to be pretty clear about what you're doing here. Otherwise, you can make profit and you end up giving it all back again. Okay, there's a question here about the divergence on the MACD and the RSI on the S&P. Okay, I think I understand what that question is. Yeah, we sort of have a little bit of divergence, I guess. Not so much evident on the RSI. What we're talking about here is that the MACD is forming lower highs, lower lows. So there is a divergence there, and we've got the price continuing to form higher highs. So yes, it's there, but I never take any single indicator in isolation. I would never look at that and say, oh, there's divergence, therefore I'm getting out of the market because, you know, blah, 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 someone said the US market's going to roll over. You know, there's millions of people saying the US market's going to crash. I just don't buy it until I see it. And, you know, the proof of the pudding has been I've made a lot of money in America in the last 8 months. And if I, you know, looked at that and got scared by it in isolation, then I would never have made that money. So I'm going to keep trading the way I'm trading. I've got a completely open mind. I'll change my mind in an instant, but at this point in time, I don't see any evidence of the US market rolling over. Next question is it okay to have an SMS, a self-managed super fund with long-term goals running alongside an active investment portfolio for shorter-term gains? Ted, absolutely. That's exactly what I do. I think it's the best of both worlds, and you know, you're a member, so talk to me if you want to pursue that conversation. I'd love to chat with you about that. What's a good way to play silver? My goodness. How do I answer that? I guess in general terms, the reason I hesitate on answering, Jay, is because it depends on your time frame. You can trade this either short term or longer term, and I don't know what you would be, you know, how you would be trading it. Yeah, look, it's such a volatile little beast. I would need to. There's not a simple answer to that. It depends on what your actual trading style is and how much you wanted to risk. But yeah, and I'm sorry, I'll have to renege on answering that question just because of the volatility of silver. I don't want to give you an answer that you think is worthwhile and, you know, it turns out not to be complete. Okay, well, that appears to be pretty much it for tonight. So again, let me just reiterate, I'm really keen to talk to people and work with people that want to do this properly. And, you know, if that's you, if you want to make money consistently and reliably, then I'm happy to give you everything that I've got. Drop me an email and we can talk further. I hope this has been helpful for you, and look forward to at least talking with some of you. That's it. Cheers.